Investors won't be receiving a dividend this time around. The company, which has faced troubles in the past due to its Waratah train contract with New South Wales, says full-year guidance is on track. Meanwhile, across the Tasman, Contact Energy has reported a lower half-year net profit, largely on low hydro generation volumes. Interim net profit came in at 68 million New Zealand dollars, down almost 20% compared to the same period a year earlier. Underlying earnings after tax, or net profit adjusted for significant items, fell around 3% to $76 million. Contact will pay an interim dividend of 11 New Zealand cents a share. That's the very latest news to the moment. For now, it's back to you in the studio.
Thanks, Kate. Let's get on to something else coming out today. So we've got company earnings, we've got Greece package developments, hopefully through the morning, but also the market's waiting for the release of the RBA minutes for January. Analysts expecting a more dovish tone from the bank. Let's get across to Stephen Nash, who joins us from FIIG Securities this morning from Melbourne. Good morning to you, Stephen. The RBA's minutes today, what would you expect the tone to be, given we did get that surprise kind of move?
Look, I imagine
these are for February, of course. I think that just said January, but this is for February, right?
Yeah. I think the tone will be indicating that the decision was finally balanced. The market, was expecting, that there would be an easing and there would be a series of those. I think what the market missed is the change in the global outlook, and that global outlook has improved dramatically from last year, and I think given that change has occurred, we've seen some releases, particularly the speech by Lowe recently, indicating the RBA is a little bit concerned about inflation. So it seems as though if we get continued solid indications on global growth, the RBA will probably revert back to its concerns about inflation. So it really depends going forward on what happens in terms of perceptions of global growth, I think.
Where for Australia are those pressures on inflation coming from?
What Lowe was indicating was that with the high Australian dollar, the non-traded sector is inflation is quite robust at the moment. If we had a reduction in the Australian dollar, say down to 75 cents, there's somewhat of a concern that inflation may rise or may become somewhat more elevated than it is at this stage. Obviously, that's a scenario we haven't got right now, but it's just a concern of the RBA right now.
Can I ask you about the possibility of more increases in bank mortgage rates? Just referring those, Stephen, to some analysis that's been done by Societe Generale. And got some headlines this morning because the French bank has said that rising Aussie bank costs are impossible. This is the headline, but they basically said that it's almost mathematically impossible that total funding costs for Australian banks are rising. They basically go on to say that they've looked at APRA numbers, banking statistics, RBA data on debt, securities, and it all shows that the source of most bank funding is onshore, and that's where costs are actually falling. Now, you can be an independent, adjudicator on this kind of issue for us. Of course, the Banking Association is saying they don't even have the numbers. It's impossible that they could work any of that out. So how do we understand this?
Look, I think it's fair to say, in terms of the major banks and the banking sector broadly, that there has been an increase in senior debt funding levels from last year. The market got a bit carried away with it and pushed out those funding levels dramatically in the first part of the year. That has moderated of late. Maybe that's where the Societe Generale indicators are coming from, because we have had somewhat of an improvement recently. For example, the covered bond by CBA was issued at 175. It has traded in to around the 135 level, so things have improved. However, it's fairly obvious that the major banks have a lot of funding to do, so I would imagine those costs, again, will start to become more elevated as that supply becomes more apparent. As you know, we're seeing quite a few hybrid issues right now, and there will be other wholesale deals in the senior market. So I think that the banking sector has had an elevation in funding costs, but I think the banks have a job to do in terms of explaining that more broadly, I think.
And maybe offering some more figures. Do you feel like you've got the figures you need to be understanding the issue?
Look, we can basically break down the funding of the major banks into the deposit side and then the senior funding side. And, you know, putting them together, there is an argument for an elevation in funding costs. What's really been the problem for a lot of the major banks and banks broadly is the connection with their funding costs in terms of overseas markets, and that's what we call the basis swap. And that's been quite elevated of late, and that's probably one of the major problems for the major banks right now. Again, that has improved a little bit of late, but still, it's fairly apparent that those costs are quite high relative to last year.
Stephen, anything else worth mentioning regards to the offshore situation, maybe how bond markets have been anticipating the Greek debt deal?
Look, I think the bond market's really been, in terms of the credit markets in particular, we've had quite a large contraction in credit spreads as the equity markets have rallied. For mine, I think that the bond market has really bought this rumour of a Greek deal. If we get a Greek deal, I imagine that the credit markets will sell off as they've bought the rumour and will sell the fact. If there is no deal, I imagine the equity market and credit markets may sell off as well. So I don't see much upside here right now in terms of credit spreads or equity markets.
Thank you so much, Stephen Nash.
Okay.
We could always chat for longer. We appreciate you coming to our Melbourne studio today. We'll see you back in Sydney soon. Thanks.
Thanks very much. Okay.
An update on